let's get started. Chapter 7. Okay, chapter 7. We're gonna go over chapter 7 and chapter 8 for today. Eventually, they are my most favorite part. Chapter 7, we're gonna talk about capital gain or capital loss. Okay, we mentioned this last session already, and so what is a capital gain? Let me give you one example. Okay, that is really important. Okay, capital gain, we must talk about four different types properties. Okay, they are all in your books. Okay, so for example, if Mr. A, and he's a collector. Okay, he's a painting, antique, okay, that kind of thing. Say Mr. A, especially right now in China, okay, everybody is so crazy to collect, the modern art or the ancient antique. So Mr. A collect one ancient paint, and he spent $1 million US dollar for the painting. And 6 months later, he sold this paint at $1.5 million. So we know the basis, let's say, cost is $1 million, right? And the amount he realized is 1.5. So very easily we know Mr. A makes 500,000. But if we compare the same situation. Mr. A spent $1 million for the paint, same thing, exactly same thing. But only difference here in this scenario, Mr. A is the gallery dealer. His business is to purchase and sell. Okay, Mr. A operates an art gallery. Same thing. Okay, he spent $1 million and sold for 1.5. If everything are the same, scenario 1, Mr. A is collector. Scenario B, Mr. A is paint dealer. So it is different. If the transaction happen in case number 2, if Mr. A purchase and sell as the dealer, and can anybody tell me this 500,000 profit will be accounted as what? Ordinary income, because we talk about the income already, right? In the session 2, right? We talk about all different kind of income, right? If Mr. A is the dealer, he spent $1 million as cost and then sold 1.5. If this is his ordinary business, and Mr. A cannot report as capital gain, you will become last session, all right? Probably on his schedule C, if he operates this as an individual, or report this on the corporate income if he operates under his corporation. See the difference? So for chapter 7 and chapter 8, we only talk about capital gain. So that really means before we go to chapter 7, we need to define property. Okay, property define. Okay, the property sold are either for investment, or the property sold, that property was used in business. Or, of course, if the property is used as a personal, there's another issue. So as long as, okay, let's define it, as long as the property is not defined as inventory, then we will talk about either capital gain or capital loss. So be very, very careful, okay? So let me repeat, okay? Before we go into the chapter 7 and chapter 8, chapter 8 eventually is the exception for chapter 7. if you already read the book. Chapter 8, we will talk about exchange, deferral exchange. That means chapter 8 was qualified as chapter 7. However, for special reason, if you under the transaction under chapter 8, then you don't have to pay the capital gain. So we're gonna focus more in chapter 7. Okay, we only talk about a little bit in chapter 8 for today. So just be very, very careful. Okay, before we talk about chapter 7, we need to define the property, what kind of property it is. The simple rule, okay, the very, very general simple rule is, as long as the property sold is not inventory, it is not inventory, then we can talk about chapter 7. So chapter 7 is very broad, okay. The property we sold is either for investment, so like stock, right, like a collection, okay, or the property we sold is for your business use. So for example, last session, we talked about office equipment, right, computer, your printer, furniture. As long as the property was used, in the business, so that qualify for chapter 7.
How about office?
Yes, building,
Building.
yes, of course, right. Or the last thing is for your personal use. Okay, for your personal use, the rule is very, very special. For personal use, for example, your car, your automobile, okay, you are the W-2 income taxpayer. You don't have any other income. So the automobile you use every day, that's qualify for as personal use. So if you sold the property, if there's a loss, no any report, no any deduction. So for personal use, if when you sold it, it's a lose. Usually, you lose because automobile, the price always go down. So for personal property, if you sold it, losing money, you cannot deduct anything. But if you make profit, you need to count it as a capital gain. Very, very special. Very, very special. Okay. So let's take a look at chapter 7 very quickly before we go to the detail.